G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Alan Wargent Property Buyers. I'm here with Chris Bates from the Alcove Group. Chris, how's your week been?
Going good, Pete. It's evaporated as usual. We're recording this on a Friday, which we used to do it a bit earlier in the week. But head deep in a website. It goes live next week. So pretty pumped for that. And we're off on holidays next week as well. So it's looking forward to that. What's news in your world?
I've been in Bonnie, Scotland this week, up in Edinburgh. So it's been an absolutely beautiful week up there. So it's the Edinburgh Fringe Festival kicking off this week. So, or at least it's kicking off very soon. So it's just starting to get really busy. So I managed to sneak in ahead of that and just catching up with a few old buddies from many moons ago. So it's been pretty nice, actually. I've had the kids in tow and just sort of blinking in disbelief at some of the housing prices in the old town. But I suppose that's a global issue, isn't it? You want the well-located properties where you can walk to all the entertainment and amenities. You pay through the nose for it. And also, it seems like everybody's doing Airbnb up there. So I think there's been a bit of a crackdown at the government level. So maybe something to watch out for in Sydney down the track. So that's what I've been doing. And just as I logged on this morning, I see Cotality released their July housing price index, which no real surprises there. Solid gains for every capital city, although Hobart was fairly flat, and then a big outsized gain for Darwin, but it's pretty much as you were, 0.6% growth over the month.
Yeah, I think, and all the news articles jumped on that. And, it's interesting. Tim Lawless sort of came out this morning, so basically saying, or maybe it was the last couple of days, but he doesn't see prices running. He thinks maybe it's also going to be the medium and top end of the market that's going to start to run a bit harder, because the medium end and to the lower and more affordable parts of the markets have been growing a bit stronger over recent years, which hasn't really usually been the case, particularly over the longer term, I would say. But particularly in the last few years, there's just been a real compression in borrowing capacities, and higher interest rates mean people want to spend less on their mortgages or have got the ability to do so, and a freezing up of the market, particularly at the medium and higher end. So that was an interesting sort of comment that he made. But really, I think depends on how much borrowing capacity increases, and that depends on how much rate cuts there are, whether APRA steps in, and whether there are longer loans and some bank innovation come out, like removing HEX, etc. I think that's going to really determine really where prices and how much there's strength in the market.
I've seen a bit of that up in Brisbane, a couple of suburb records this week, and houses going for 3 mil, 4 mil in Camp Hill I saw this morning. So yeah, there's definitely some real pump in the market at that end. But as you said, the lower end of the market has got a bit busy in recent times, and obviously all the first home buyer stimulus is just accentuating that. One of the interesting things in Tim's release there from Cotality was a re-acceleration in rents. So I think rental price growth, it seemed to have sort of tapered off a bit. People were citing affordability issues, but the past 3 months, another 1.1% increase in actual rents, I should say, and with rental vacancy rates still hovering around all-time lows. So yeah, that's been interesting. There's always a bit of a tension between what some of the private measures show for rents and then what the ABS records for rents, because the ABS is recording the whole housing market, and it doesn't really measure the same thing as some the other indices like SQM's asking rents. But in any case, it looks like that rental crisis or that rental crush just hasn't gone away at all. And in fact, if anything, rents seem to be re-accelerating again, which is, I guess, a bit of a concern.
Well, I mean, it's a concern for inflation, but it's just a concern because, I've done a little bit of looking at this week, actually, and a lot of rents have, for example, in Sydney, have gone from $500 to $800 a week. You look at pretty much around the whole country, the last 4 years, the rental increases have been enormous. Places like Melbourne and, in vacancy rates are really tight around the country. And so A, it's hard to move, and B, your rents are going up, and C, it's hard to sort of enter the market. I do think the rental pool is very mixed. Some people are first home buyers that will, have the ability to buy, but some people just don't have the ability, right? They have to, they're choosing to be in the rental market because of what they do for work, etc. So they're just having to sort of wear this at a time when everything else in cost of living is really high. So this was one of the things that I do think from a social issue, we really need to contain rents. But to do that, you really need to create more rental stock. So you've really got to encourage more investors into the market, because institutional sort of investors are pretty much non-existing. This build to rent's a lot of hot air, I believe. It's not really moving the needle. It gets a lot more airtime versus the actual impact on the market. And we need to encourage more investment into the market. But that's not what, wins votes. That's not what people want to hear, because they think that's the reason why prices are going up. But I think the investors have really shifted where they're buying over the last few years. They've gone to regional locations. They've gone to, outer suburbs, and not typically where they've gone in the past. And I think that's what's really creating a rental crisis in our capital cities, where more investors are leaving versus the amount of investors buying.
Completely, yeah. I mean, one of the things that just comes up when I've been chatting to people in my travels around Europe is, I guess, very similar dynamics, really. Basically, a complete stop on immigration when the COVID rush, so when the COVID lockdowns happened, and then a massive snapback. And the Office for National Statistics reported this week for England and Wales 700,000 or 707,000 population growth in the year to June 2024. It was over 800,000 in 2023. Completely unprecedented numbers. And yes, a big part of that is the snapback from COVID. But of course, it's manifesting itself in a lot of tensions. Rental stock is just incredibly difficult to find. There's a lot of graduates complaining that they're graduating and they can't get roles in the health service or elsewhere. And yeah, I mean, it's interesting when you talk to people, a lot of younger folks are saying they feel very hard done by, because they were sort of promised a degree and then an easy step onto the housing ladder once they get a professional career. But there's, of course, a lot of competition for jobs and for rental housing. And yeah, there's always sort of two sides to that debate. I think it's often said in Europe, well, yeah, the sort of Brits won't do a lot of the sort of menial type jobs and agricultural jobs and so on. But then the other side of that is, obviously it does have a bit of a depressing effect on wages if you have very big population growth. And Australia isn't at those kind of extremes, where we do have big population growth pressures. And I think we'll look at the inflation figures shortly. But when you look at where the residual inflation is, it is kind of stuff that's related to population pressures. So yeah, those debates are pretty red hot in parts of Europe at the moment. In Australia, it's kind of been an ongoing thing for 25 years. What's the right level of immigration? And of course, record low rental vacancy rates are when those debates tend to flare up a little bit.
Yeah, I saw an article here from Nerida, which you've just put in here, the fortress suburbs and spillover suburbs. What was your take on that, Pete, when you read it?
Well, yeah, I guess it's a little while since I looked at it, because I've been mucking around in Edinburgh all week. But yeah, there's a couple of interesting sort of opinion pieces this week. I think the one that really sort of caught my eye, just looking through some of these sort of articles this week, was, well, Cameron Cusher did a piece on what's conspired to increase prices, but also Cotality also showed that where people are really bidding up prices is public school zones in particular. We've definitely seen that in Brisbane. I think if people want to get into the right schools, even in suburbs that are quite a long way from the city, you do tend to see like just a big rush of buyers for the right property that's walking distance to the school. And there's a couple of sort of example suburbs in Brisbane that aren't even that close to the city. So yeah, I guess those are the I guess those are the sort of trends that we're seeing, is that as you said, there's some of the demand for properties coming back at the higher end, and it's particularly that sort of family friendly school zone type of property. I guess yeah, and in terms of Nerida's piece that you mentioned, I guess we always think in property about the idea of the kind of the ripple effect, where you get a blue chip suburb and it kind of, when people get priced out, the prices ripple out to the next available suburb and you get the gentrification. Well, I think yeah, I mean, Nerida's done some analysis here of what she calls the kind of spillover effect, where some of these cheaper areas are actually seeing sort of faster price growth across all of the capital cities. And she's just done a sort of a list of the top suburbs that are impacted. So yeah, I guess it's places like in Perth, like the traditional blue chip areas like Cottesloe and so on. It's seeing sort of big sort of price growth rippling out to places like Freo and so on. It's the same actually all around the traps. In Brisbane, it's sort of gone from New Farm to West End, and then in Melbourne, South Yarra to Richmond. Similar in eastern suburbs in Sydney, Rose Bay and Dover High. So I think these are sort of trends that, as you say, over the long term, maybe prices don't diverge so much. But in the short term, if you get this differential between exceedingly popular suburbs, then prices kind of just spill over or ripple out to the next best option.
Yeah, I think it's sort of a different take on the bridesmaid strategy. So, if someone's paying a premium, I mean, I grew up in Newcastle, right? And Merewether, everyone wants to live in the Merewether postcode. But if you just go over the next couple of suburbs, you go, well, I get a lot more for my money and I don't have to spend anywhere near the amount of money. And I think that's, a good idea when a lot of buyers get pushed out of one side. They go, where can I get the same lifestyle within reason? But I get it for a much better deal. And I think that's when you see this disparity in prices. I remember all the way back in the, say 2012, my sister was looking to buy a place in the inner west of sort of Sydney. And we're like, well, if you buy Annandale versus Leichhardt, and, you just get so much more for your money versus, say, a bit closer in Glebe. But, so when you're buying, I think that sort of disparity in prices. I mean, I think, and some suburbs are literally what, Nerida's talking about is fortress. People are paying a lot of money for the status or to have that postcode. And, maybe it's better off why you say if you don't really need that status, potentially you're better off buying in a bridesmaid suburb or a spillover suburb just up the road where you get a lot more value for the money, and a lot of buyers will move to when that market gets out of reach. I think it's that was an interesting take on things. And I mean, the school zones, do you really want to? Yes, you pay an extra 2, 3, 4, 500 grand more for your house, let's call it, but does that save you? Particularly when you got 2/3 kids, does that save you $1 million in school private school fees? And I think that's always been the case. In the past, people have, and is it better off to put that money into an asset that grows for you tax-free versus putting that to school fees where the money evaporates? You pay more interest, but the interest might be less than the private school fees.
Yeah, I was just reading the summary of Nerida's article there on the fortress suburbs. Those are the kind of irreplaceable prestige suburbs like Double Bay or Dover Heights, where you got the clifftop views, or Woollahra, Mossman Peninsula, and so on. And in those prices, those sort of locations, price is almost secondary to just the status. I think we talked about this previously on a podcast where you get effectively Veblen goods, where people almost would rather just go to the absolute prestige location and they'll pay almost any price. It's almost secondary to just being in the top suburb. The same thing happens in things like private schools. Private schools can increase their fees and people will still go, even if it's $50K a year, because people just want to go to the top school. I think the ripple effect holds true, but there's certain suburbs like Toorak and so on where it doesn't seem to matter. The prices just keep rising. And we definitely saw that in London over the years in West 1. You just look at the prices, insane. And the prices just kept on going because people wanted the postcode. All right, let's go down to our big 3 property news stories of the week. Stick around because at the end we'll cover some of your questions in our listener Q&A. So first story this week, AFR did a nice little piece. The everything bubble is back, but this time could be different. So I think the interesting thing when you look around the traps, you've got sort of asset prices have been rising everywhere. Stock markets, housing, crypto is kind of boomed back. And that's kind of juxtaposed against, in a lot of places around the world, bond yields at the sort of longer end have been rising. So it's a case of almost like, something has to give here. I think the really weird thing is, if you went back to about 3 months ago, there's all these articles saying, Trump's stock market is the worst ever, first 100 days for a president. And I mean, not to pick out too many sort of people, because I suppose it's very hard to predict short-term trends in stock markets. But I'm just looking at an article here from Bridgewater, or a newsletter, saying this is a once-in-a-generation economic shift. exceptional risks for US assets. Stock markets are going to be down 30% and so on. And then here we go. 3 months later, the S&P 500's gone from below 4,900 pretty much back to an all-time high as we speak here, about 6,400. The CAPE ratio is basically the highest it's ever been outside of the dot-com bubble. And pretty much any metric you look at, PE ratios, everything else, it's just super frothy again out there. And I suppose it just goes to show, in the short term, it's just so hard to predict this stuff because go back 3 months ago, it was dire warnings about markets crashing. I suppose what the AFO is trying to get to is why is this happening? And I guess, look, you could pick any number of reasons, but I think the most obvious are, fears of money printing, fears of longer-term inflation, currency debasement, and maybe even just people fearing that they're going to be replaced by AI and therefore just trying to get their money into asset markets, trying to, even if it's at a frothy price, just trying to speculate their way to wealth. So, yeah, I mean, what do you reckon? I suppose when the stock market comes down 20%, everyone will say it was obvious, but whether that happens now or 6 months or 2 years or whenever, who really knows?
I think what we just need to assess is that there's a lot of money flowing around, right? It's property market's been going up. Absolutely, some people are feeling it if they've had big mortgages and they leveraged up in the last 5 years prior to the increases in interest rates, so they're dealing with the pain. But if you didn't leverage up, you're pretty, 4 or 5 years before that, or at least 2 or 3, but with very low interest rates, you probably had a much smaller mortgage, a lot of equity in there. Maybe your salary's gone up a lot. You're putting 12% into your super fund now. A lot of super balances are quite high right now, and that's getting invested in markets every month. A lot of younger people who couldn't enter the market, did use crypto, right? And there's been a crypto boom there, so they've benefited from that. And so, yeah, there's absolutely a section of the society that, you think about all the baby boomers, right? Look, their super funds, they can't spend it as much. Even if they put it in cash, they're getting, 5% on that right now. So they're pretty happy. And so I think, yeah, there is a subset of the market. And this is why the interest rates aren't as sort of elastic as, you think they are. You increase interest rates, so you're only hitting a certain portion of the market who are usually leveraged up. A lot of other people are probably not that concerned by higher interest rates. And, and that's why it's not as effective as it should be, right? And what's your thoughts on actually cash on account in Australia? I'm just trying to bring up some numbers, Pete. I think as interest rates come down, there's a lot of people with equity. We've seen an investor boom even with higher interest rates, but as interest rates come down, you'll find that a lot of people who have got equity, they get maxing their super contributions. They're going, what else should I do for my retirement? Yes, they may be concerned about their long-term future, and they're like, well, I need to build wealth while I have got a job. And so I think you'll find that the investor market stays strong as rates go down. And particularly, it also means taking money out of cash, and it's also ability to sort of borrow against your home loan to buy into shares. And so if anything, if we say that inflation's back in the bottle and we're going to see more and more rate cuts, well, I don't see why investment markets, in terms of people looking to put more money into them, is going to slow down, right? What's your take on that, Pete?
I think just to wrap up on the global market scenario first. So this is a quote from the Fin Review article. As SocGen strategist and Uber bear Albert Edwards said, "One thing I can promise you all with 100% certainty is when this mega bubble finally bursts, almost everyone you meet will say it was obvious." Yeah, I think we'll come on to the Aussie inflation figures shortly. I think you're right, though. When you actually look at things like debt to asset ratios in Australia, they haven't really increased because asset prices have gone up. Debt to income ratios, they haven't really changed much for 15 years. We've got a lot of money in offset accounts and redraw facilities. So I think that's it's just something that the Aussie numbers are just a little bit different from other countries. Because at the headline level, yes, we've got a lot of debt, but we've also got somewhat uniquely sort of big amounts of money just sitting in offset accounts or mortgage prepayments and big buffers. So I think when the appetite is there, you can see when sentiment shifts, then suddenly people come piling into investment markets, and that's stocks, superannuation. It's also the property market in particular. Where there's just so much equity there sitting around. So, yeah, look, I think if if interest rates do come down, I think we'll definitely see some of that in Australia. I do wonder whether the rate cutting cycle might not be as pronounced as people are expecting. So, well, let's come on to that now, actually, and then we'll sort of make a judgment call. So the June figures for inflation were out this week. I think it's interesting. We've got predominantly variable rate mortgages in Australia, and even though we didn't take the cash rate target as high as a lot of other countries, it seems that inflation has come right back down. So the headline inflation figures were a bit softer than expected, 0.7% for the quarter, only 2.1% over the year. For core inflation, 0.6%. So that was also a bit softer than expected. So if you look at market pricing, a rate cut is fully priced in for August, and we've got a total of 3 for 2025. I think the flip side here, Chris, is there's quite a bit of other data is improving. If you look at retail turnover, a bit of a surge last month, building approvals, 2-year high, new home sales have suddenly taken off. Credit growth has been pretty solid, especially for business credit growth. So, look, I'm sure a fair bit depends on Trump and tariffs and all of that stuff going on in the US. But, yeah, I mean, markets are pricing 3 rate cuts this year, which would mean probably variable rates down to 5% or lower. Pretty bullish. But maybe we don't need that many cuts if the data is starting to improve.
Yeah, and I think, I'm just looking here, the ABS stats on, household wealth, $1.8 trillion, if I'm getting these numbers right, in offset accounts. So, that money will want a new home as, as interest rates go down. People will be like, well, am I better off to invest that money on top of the $8 trillion in equity in property that some will be getting released and passed down to next generations, where we don't see the intergenerational wealth that's happening. And so, there's a lot of talk that households are struggling, right? But there's just so much wealth held up there. This is actual money, right? I don't think, yes, you got to pay interest rates. Yes, you got to pay costs of living. But, a lot of people have still got returns on assets that they can sell down, whether it's sell down properties or sell down shares or use money in offset accounts to balance the budget. It's just a small portion. Hence why you can see arrears is, only, 1 or 2% of the market, right? It's not, and even that's only of the people who have got debt, right? So, what's your sort of take on that, Pete?
Yeah, I think people continually underestimate, probably including myself, the sheer weight of household wealth in Australia. It's last time I checked the stats, I think it was about 17 trillion, and that's more or less tripled since 2009. And it's not, contrary to what people think, it's not all property, it's not all housing market stuff. Yes, probably about half of it when you net out the mortgage debt is housing, but you've got superannuation balances at record highs. You've got stock markets have just touched a record high just recently. Lots of money sitting around in cash as well. So, look, it seems to be the case that, Australia is the lucky country. And, so I did see something that pops up every year, people complaining about the lack of complexity in Australia's economy. Yes, quite heavily focused on resources in particular, and mining exports. But, I guess, those are potentially complex industries themselves, and we've got tourism and students and so on. So, I think, there's pretty much a job for everyone who wants one still at the moment, and households holding up pretty well. I think, just to wrap up on those inflation figures, where did the inflation come from? Well, electricity prices, basically, as all the government subsidies kind of run out or roll off. Sin taxes on alcohol and tobacco, as always. But I guess the other bits and pieces, it's really where there's population growth pressures, health, education, a little bit of pressure on food prices. So, I think for lower income households, there's still some cost of living pressures there. But I suppose, look, all things considered, when you look at all of our peer group countries, Australia is pretty much about the best placed of all of them. We've got the inflation rate back down to 2%, or I think it was 1.9% on the monthly inflation gauge. They'd be pretty happy with that. I know the RBA always cops flack from people. It's almost a national tradition. But I guess if you think about where things might have gone and, how high they might have taken interest rates, actually things have shaped up pretty well overall. What do you reckon?
Yeah, what's your thoughts on this? Obviously, there's a lot of, is it the Treasurer's doing the Productivity Commission, sort of economic sort of round table that's happening over the next few weeks, Pete? Do you think it's just going to be a lot of hot air, a lot of people just talking it up, but the reality is people are winning votes and staying in power is a different story?
Yeah, I think government spending has been very, very high in Australia recently. I think we've got away with a little bit, or it's been sort of papered over because we've had such a low unemployment rate. The unemployment rate was down to 3.5% at one stage, something we haven't seen for decades. But of course, as unemployment creeps back up, it's now 4.3. It's probably heading a bit higher. Well, suddenly you'll find there's just a structural budget deficit. So I'm sure they'll be looking for ways to raise more revenue. It's not very popular to cut spending these days. And the NDIS cops a lot of the attention because there are just so many examples of people rorting that system, and the funding isn't always getting to the people who really need it. But yeah, so I think they'll be looking at ways to raise more revenue. Capital gains, there's already been a couple of articles floated around on that. And at the state level too, actually, I think some talk this week that maybe in Victoria there could be some taxes on people selling property potentially, although that's just speculative at this stage. So yeah, those things, yes, you're right, there probably is a lot of hot air and people talking their book, but I wouldn't be surprised if there's some tax reform in the offing. And housing is just such a big target. When you think of an asset class that's worth 10 or 11 trillion, it's an obvious place to go if you're looking for more tax receipts. So, yeah, watch this space. I think it's 2 or 3 weeks away, isn't it? So we'll see what comes out of that. Last news story for the week before we come to our Q&A, the return of prefab housing. So, Chris, you pinged me the article on this from the AFR. Looks like CBA is teaming up with some modular home builders to potentially get lending in the sector up to 80%. So, yeah, what do you think is going to come down the line in that regard? I know you've looked at it previously on other podcasts.
Yeah, I mean, I've always been fascinated by this. I've got a mate actually just bought an amazing, built an amazing prefab house up on the beaches here. It's absolutely stunning. It's sort of Norwegian company that basically provides you. I think you got it for like 250, 300,000. This, and it's like a barn looking house, and it's he's got these little deck in the middle to connect these two little barns, and he's done an amazing strategy. He's sort of buddy house and basically sold a renovated house, and then bought this block of land, and then built this really cheap prefab on this amazing block of land with views. And I just thought I'd look at it, and the house next door, because they bought a double block with their mate, and I look at the house next door, and I think he's spending $2 million. He spent like maybe a quarter of what he's spent. Has he got a house as quarter as good? I would say no. And this thing has gone up. They're living in it, while this other place next door is, as they only just got the slab down. So their time to build, their cost to build, and maybe it's not as big, but this is it's an amazing house, and it's not some ugly looking thing. This is very nice looking prefab. And so I just think that I think there's been a lot of negative sort of, and I think the building market, talk it down a lot. They're sort of stuck in this sort of mass building, and I think there's a lot of innovation that could become from, modular building and building offsite. I mean, right now, it's absolutely pouring in the beaches right now. Can you build? Can you be out there on site now? No, you can't. But could you be working in a factory right now building houses? Absolutely. And so I think this is just the direction we needed to go in. But I remember talking to Archie Blocks about a decade ago. We've got clients at a lot of the bigger modular building places as well. So I've seen some cracking builds. I've watched this space for years, but I tried to get finance on these years ago, and basically the banks say, no, we can't do it because you can't control the risk. And, in the last few weeks, we've seen some CBA come out and said, no, we're willing to do this. We're willing to support it. And hats off to CBA. I mean, CBA have got a much bigger, they're the biggest bank in the country, right? And they've got a huge credit book. And so if they do get a few losses on their overall book, well, then they can sort of manage that. So it'd be harder for small lenders to do it. But, if CBA do it, and, NAB jump in, and ANZ jump in, and Westpac jump in, and all of a sudden this modular industry has got the financial backing, because, if you want to do a modular build, before you had to do it with cash. So you think about the subset of the market that can afford to do builds with cash. It's very little. Most, and particularly now when they've got a debt on their home, and they need to do it on their end build. They need to do a construction type facility. And to be able to do that on modular is the game changer that industry's been needing. And I think some companies that have basically invested millions of dollars in building factories and getting things done and just haven't been able to get off the ground because the demand just wasn't there. I think they've taken the brunt of it, and the ones that are set right now and can take advantage of it. And so, yeah, it's a very interesting story to track. I do think it's part of our housing solution is supporting the modular industry, because I think it'll not just be at the affordable end, it can go all the way to the very top, as that example I just explained.
I think even the term prefab, it just it has this kind of negative connotation, really. I know that in the UK there was always these. You still see it even now. It's sort of post-war. They call them non-standard construction properties, and then it'll be listed online on Rightmove, and it always says cash buyers only, because no bank is going to touch a post-war prefab. But we're not really talking about the same thing here. A modular home builder today is sort of the output of prefab dwellings. It's a much higher quality, basically, and I think, speed and cost are the big benefits. So CBA is funding the construction of a big factory on the Sunshine Coast for Ollie Homes, who will increase their annual average from 200 to about 550 homes a year, and lending up to 80% from the second quarter of this year. So, and as you said, this might not be in itself a silver bullet for the housing market, because not everyone wants to live in a prefab or a modular home. But look at building approvals this week; are up to 17,000 for the month of June, and then you get a couple of months of 18 or 20,000, and suddenly we've got a big potential pipeline of dwellings, and this kind of thing just adds to the potential pipeline. So yeah, I think it's definitely a move that's going to sort of add to supply as we go forward. And I think if one bank leads the way, then other lenders will follow. And we'll probably be hearing more and more about this as time goes on in Australia, because in Europe it's definitely been a thing in some of the sort of Scandinavian markets. And yeah, I mean, the innovation is quite amazing, really, when you see how quickly some of these things can be put up.
Yeah, and I mean, I would just go look at Modscape if you're listening to this, or another one called Pre-Built, and just look at the quality of some of the homes that they're building. They're absolutely stunning. And you think about as a build, when you're doing any reno, it's the cost of how long is it going to take to build it, your holding costs, and is there going to be things that pop up that really blow out your building cost, and modifications. And the benefit of doing these things, that yes, they are a little bit cookie cutter in terms of there's restrictions. It's not, and some sites make it harder to do modular, right? And they're potentially maybe, but technology is getting better, and they can cut things with machines. They're not cutting things with people on site, and they can just basically bring it to site when it's ready to go and put it all together. And so, yeah, I think there's a lot to look at in this industry, but I think the funding has held it back. And so hats off to CBA for biting the bullets. A lot of banks just don't do these things. I find that they're just lending money, things that are a little bit off kilter, and takes years to get through the system. Even new loan products that, a little niche that comes out, or a fintech comes out with a great idea. It just takes years for it to sort of get traction, because the banks shut it down and go, I just haven't got time for this. I'm too busy trying to sort out my back end team. But I'm excited to see this come through. I remember I rattled the 10 years ago, and all the banks just basically laughed at me and said, we're just going to keep lending to first-time buyers. Thank you.
Yes, I'm not surprised, but more innovation on the lending side as well. We'll no doubt see this increase over time. So let's wrap up with three of your listener questions for this week, and then we'll wrap it up for the weekend. So firstly, from Suraj, how do I choose good commercial real estate stock? Gosh, that's a short question, but a big open-ended one, because commercial property, when you think about it as an asset class, it is so diverse and so big. It could incorporate anything from agriculture and farmland to office space, retail. You've got potentially industrial and warehouse type properties. I think the most popular stuff for mum and dad or retail investors in recent years has been the industrial property. I think it's the kind of yields have been in the range of sort of 6 or 7% sort of net yield. So you can see why that's attractive. Potentially something where if you've got a good tenant in place, you can sort of pay down the mortgage effectively with the rental income. I think, I guess assuming a few things here, but assuming you don't have much experience in the space, I would say probably warehouse or industrial is the sort of the lower risk type of property. But I would say if you're new to the game, probably stick to something fairly generic. So if you lose your tenant, you can potentially find another tenant reasonably well. And obviously a lot of the sort of growth drivers for this type of property would be local economy, good diversity of employment and industries and so on. But yeah, I'd be a bit wary of some of the niche types of property, because what you don't want to do is buy, I don't know, a bowling alley or something, and then a tenant leaves and then you've got a bowling alley. You know, I think you want something that's going to have been sort of consistent high demand. And if you've got a long-term tenant in place, happy days. But if that tenant finishes, you don't want to have a long vacancy. So yeah, those are just some general thoughts from me, Chris.
Yeah, I think residential property, it's quite easy to read the market. You're buying a piece of dirt and you know who the demand is going to be long term. If that person stops renting it, you can always go back into the rental pool. It's really simple. I think the commercial market is nothing to be compared to the residential market. I think it's a whole other investment asset class, and you need to basically apply a completely different philosophy to it. Maybe demand and supply, but you can probably apply that to lots of investment markets. I think everything that's in a commercial market, I reckon it's factored into its price. And particularly in the last few years, we've seen a lot more demand coming into the commercial market. And I think a lot of probably people in the market thinks the dumb money, right? Like it's money that are coming in with residential sort of mindsets, and mum and dad investors are coming in. And I think that's not the money that the top commercial investors would be looking at and going, why the hell are people paying that yield for that property? Because they're applying, capital city yields to regional markets. They're not understanding the local economy. They're not understanding what the locals would really do. They haven't seen markets in downturns, and what happens when vacancy rates jump, and what happens when your tenant leaves, like you said, Pete. What happens to the value of your asset, and how does the commercial lending market work? And I think people are going into that market because there's a lot of content that's getting produced by new commercial buyers agents that are promising. And some markets have been very good for commercial investors. And so I think you got to be extremely careful how you do it. That's my take on it. I don't say that I'm an expert at it, but I am trying to get smarter and smarter at it and speaking to lots of people on it. And I think that, you've got to really be really careful what you buy, because I sort of see it like shares. It's kind of like buying an individual stock. It could work really well, right? Like if you buy a company at a great time and information in that market shifts and it makes that company in better, then you've got all your eggs in one basket. But the same thing can happen with if you buy a company that, the news on or their forecasts or the expectation of future profit and, future turnover starts to look a bit shaky, or regulation change, then, you can really get smashed in the share market. And I think the commercial market's like that as well. I think people don't understand the downside risk. And you're not buying, an office, an industrial, a shop front, all the different commercial. You're buying one individual shop on a street, let's say. And that could work. So I think the smart people are knowing how to understand yield, and they're buying things where they think they can increase the yield, which in turn will increase its capital value that will then reduce the yield. But they're understanding what's actually a good bet and what's not a good bet. And they're looking for things that are potentially undervalued in the commercial market. Like it's got a tenant that should be paying a higher rent that it's not, and they're confident that they could just redesign the property and increase the rent, and that's protected because it's a scarce asset. And you've got to be super smart in this space. So just be really careful if you're buying in the commercial market. It's a whole other world.
I think so, yeah. I mean, retail can be quite fickle. There's been a big move to online retail in recent times. In office space, obviously, with the working from home phenomenon. Just a final point on that. We have seen quite a lot of yield compression in a lot of sort of industrial or warehouse type property where people are arguably overpaying. It just seems to be very busy at that sort of mum and dad investor level. Strangely, the further up the price points you go, actually you've got less competition and arguably better deals. So yeah, just be a bit careful there on your timing. All right, second question from Tom81. It's often touted by anti-property investment folk that buying an investment property causes a reduction in the amount of properties for aspiring homeowners. Are we as investors just contributing to the home ownership affordability crisis? I think, look, it was less so the case maybe a decade or two ago, because a lot of the new housing supply was really funded by investors. But I think since the stamp duty surcharges have come in for non-resident or foreign buyers, it's not driving the same level of supply now. A lot of Aussies are buying established stock. So almost by definition, that means lower home ownership if you're getting more investors. And also it seems that investors are now amplifying the cycle. So when prices go up, investors pile in. So yeah, I think to a certain degree, yes, I think that is the case. But, somebody, I try to be contrarian. I like to try and buy properties when people can't even give them away. So it feels a bit, it's a bit odd then later in the cycle when there's a boom phase that everyone's saying, well, greedy investors, when you really, an investor's often trying to find the counter-cyclical opportunities. But what do you think, Chris?
Look, I think there is some times where you can leverage up to a degree that just is a bit over the top. And I think 2014, 15, you could borrow 10, 12 times your income. And, I do think that meant that people who had equity and income could leverage up together with long-term interest-only loans and negative gearing and could really accelerate their wealth versus someone who didn't have the ability to leverage up. I think that you can't leverage up anywhere near that amount now. I think ultimately the veil has been lifted. The benefit of a lot of investment in that 2010 to 2020 period was that rents didn't run, and we had a good vacancy rates a bit higher, which gave renters a lot of choice. And so that's providing a lot of properties or dwellings that renters can live in. And I think you need a great rental market to support our economy. And so if you take away investment, what you're going to see is what's happened in the last 5 years. Rents are going to spike. That's going to make people feel a lot less security, a lot of instability, a lot of pressure on the more vulnerable people in our society. That's going to force people to want to buy. So I think we need a healthy rental market, and we haven't got any other options besides residential sort of mum and dad investors. We haven't got a commercial play. We haven't got a government play. Build to rent's not going to move the needle. And so, yes, you could say that investors are the problem, but also if you haven't got investors, you're going to see a rental crisis. And who's that going to impact the most? And so, I think we need a healthy investment market, but also to support first home buyers into the market with sort of, for example, I think this 5% deposit scheme. But don't see yourself as a bad person for buying an investment property. You're actually creating a rental accommodation for someone, and I think people are a bit too short-sighted how they look at that. It does get a bit out of control though when you've got 25 properties and you're able to leverage up. That starts to get to a point where inequality becomes a real issue. But for someone who's just got a house and buys one investment property, are they really doing anything wrong?
It's not purely rent seeking, but there's definitely some of it. So last question for the week and then we'll finish up. So from Sydney or bust, should I move to a cheaper state to get to FIRE, financial independence, retire early at 45? I'm 36, I live in Sydney, got kids in Montessori, so paying school fees, 80k a year living expenses. We're living in our parents' granny flat to save cash. Our property portfolio is all property, $2 million mixed-use commercial properties, income of 150k a year, and we've got $2 million in loan interest. So we're on high incomes. We could pay off the loan in 9 years staying in the granny flat, at which point we'll have 150k of passive income. Is this a good plan, or should we try and convert the $4 million into a $2 million Sydney home now and build a $2 million share portfolio over 9 years? I assume the share portfolio will yield only 100k, and I'll need to keep working to make up the shortfall of 20k until I'm 50. Is this a typical scenario for Sydney siders? Well, no, not really, but we'll come on to that. How would you advise someone on this? Gosh, there's a lot in that, Chris. I'll throw it to you first, and I'll just assemble a few thoughts.
I mean, what's the motivation with fire? So you're 36, you want to get there by 45. I mean, your kids would be sort of 12 and 14. They'll still be in high school. I guess it's what are you going to do with your time till they're finishing high school? Are you still going to keep working? So you sort of, is your fire goal maybe a little bit early? I get a fire goal maybe a bit 5 years, 10 years later. But I mean, I don't know if there's 100% a rush to be completely out of the workforce by 45. I don't know. Maybe I'm wrong there. So I'd probably say that. Are you sort of setting a goal too early? Is that putting too much pressure on yourself? Is that also making you live a certain life today because you're just so focused on building wealth, and you never know what's going to happen tomorrow? And that's one of my problems with the FIRE movement is, should you be going on holiday? Should you be doing things that, I don't know. I think there's a challenge there that everyone's trying to save for tomorrow and forgetting about maybe living today. So that's the first 2 points there. Look, I think one of the things the fire industry really struggle with is if they want to have their cake and eat it too. So, absolutely, I'm totally for building wealth for your future, etc., like that. But do you also want a Sydney house paid off? So you want to live in a capital city, one of the most expensive housing markets, and you want to have that house paid off, plus you want 150 grand. So that's where a lot of people in the fire industry don't thought pattern don't get it. They don't factor in getting a house paid off and if you're living somewhere cheaper, and for example, you're living in a granny flat and you're going to live there, then it's much easier to build a big portfolio for passive wealth. But as soon as you then say, I want that, well, then you're going to take your wealth, pay off a house. What have you got left over? And so, if you're thinking the long-term thing is you want to keep living in Sydney, then maybe the best thing to do is to restructure your wealth, get a house paid off in Sydney, somewhere you can live for the next, 20, 30 years. Then you haven't got any rental costs. Long term, you've got a good asset you could always downsize from, and then use that equity to start to build other wealth over the next, not say 9 years, but over the next 15 years. And maybe whether you buy shares, whether you buy property, whether you buy commercial assets, that's another conversation. But you've got to factor in your house when you're looking at the fire movement, because at some point you might make money on the left hand, but if that all goes into buying a house, well, you're better off just buying the house. And I don't think people sometimes think about that.
Yeah, so I think you probably need to sit down with a financial advisor here, because a lot of it's personal and about motivation. Should you move to a cheaper state? Look, I did it, and it was good for us. I guess, as you said, what's the sort of motivation to retire at 45? Arguably could be a peak earning years. Maybe you need to change career or find something 3 days a week or something you enjoy a bit more. Living in parents' granny flat, gosh, look, I haven't lived in a granny flat, but I have stayed with parents for a period of time. That's challenging. Maybe it's not so bad if you've got your own space. Portfolio all in property or switch into shares. Look, I think one of the things with shares is that people focus very much on the dividend income, but you got to look at it on a total return basis. If the S&P 500 in the US has done 10% per annum, you don't have to only focus on the income component. But there's a lot of different moving parts there. If it was me, I'd probably move somewhere cheaper and find a job I really wanted to do, and then you can keep working for longer. But that's probably one for an advisor to sit through and ask those key questions for you, and then you can map out the best way to go. So that's about it for this week. So what's on for the weekend, Chris? I'm just going to see my old man, and got a show to go to, but nothing too hectic. What about yourself?
Just sister's birthday, getting ready for our holiday. So nothing too exciting here, Pete. And and get this website launched next week. So look forward to chatting to you next week.
Sounds good. Send in your questions for next week, and have a great weekend, everyone. And look forward to seeing you next time.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.